Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Monday evening, January 26th, and the title of today's audio blog is 3 Historic Central Bank Failures in 1 Week. Do I hear 4 or 5? Well, I said I'd be using audio blogs more often. However, I didn't expect to require them this often, and frankly, if I continue to be besieged by this many horrible headlines, I'm going to be using them more than even I expected. To that end, I kid you not, the negative news flow is unquestionably broader and more threatening than 2008's low point. And if it weren't for the fact that advanced financial engineering tactics, market manipulation, and a total lack of regulation, the headlines would be far worse. But all in due time, as the powers that be have essentially lost control of everything except major equity indices like the Dow, DAX, and FTSE, and of course, paper precious metals. As for the former, the they will unquestionably crash in real terms in the coming years, or perhaps months, either via deflationary crash or Weimar-like hyperinflation. And as for the latter, the same Achilles heel plagues today's New York gold pool as the 1960s London gold pool and all other attempts to mask the value of real money, i.e. exploding physical demand chasing scant physical supply. Okay, it's Monday evening, just after the close, following one of the ugliest, most ominous news weekends in some time, which, given the seemingly relentless political, economic, and financial cataclysms engulfing the world, is saying quite a lot. Moreover, one-upping last week's Swiss bank Big Bang and ECB Bigger Bang was clearly a tall order, and yet, both the near-term and long-term outlook darkened considerably this weekend, with a slew of ominous developments that will only embolden economic Mother Nature further to destroy those who seek to repeal her immutable, in some ways divine, laws. Recall how badly last week ended, with commodities, currencies, and bond yields crashing in the wake of the ECB's maniacal, suicidal, nuclear QE announcement, which frankly was so violently contrary to the market and psychological impact the ECB desired, they even trotted out one of their governors to say, if it doesn't produce the desired effect, we'll do more. I described these events in great detail in this weekend's audio blog, Hold Your Nose, We're Going Down, and after today it's hard to make the case the global economic Titanic isn't already submerged. Let's start with Friday and Saturday's gruesome Ukrainian offensives, in which scores were killed and both sides blamed the other, and threatening rapid near-term escalation. Recall, I spent much of last year mocking the Washington Wall Street de-escalation propaganda, just as I mocked their usage of recovery and tapering to obfuscate historic market and economic data manipulation. Well, it looks like I was right on both counts. And when it comes to the Ukraine, which we urgently warned of in last year's This Is What We Do, it's becoming more difficult each day to believe a major, potentially global war won't evolve from it. Immediately after the attacks, just as in each prior event, like the MH17 jetliner crash, for example, U.S.-led NATO leaders blamed Russia, and already both Europe and the U.S. threatened new sanctions. Moreover, S&P downgraded Russia's credit to junk this weekend, fueling today's ruble crash to nearly an all-time low, and inciting fierce criticism from the world's angriest bear. I can only pray the eventual resolution does not include a worst-case scenario involving mass bloodshed, particularly of the East versus West kind. However, it's becoming more difficult to believe something wicked isn't this way coming, particularly given Putin's intense hatred of America and rapidly expanding political and economic ties with China and other emerging market nations. And whilst I'm not drawing any conclusions, this weekend's damning video on Zero Hedge showing an American soldier in active engagement on the ground in Ukraine, it chills my bones to think that the Cold War I grew up with, nigh 25 years after supposedly ending, could actually morph into the hot war I spent my childhood dreading. Then, of course, was Sunday's own worst-case scenario in Greece, which, like Catalonia 2 months back, ended up being a dramatic anti-establishment landslide. And by the way, particularly given the Greek results, don't be surprised if the Catalonian secession movement becomes far greater of an issue in the coming months. Anyhow, not only did Alexis Tsipras' anti-austerity Syriza party become the Greek parliament's majority party, but came within 2 seats of an actual parliamentary majority. Within hours, it had already formed a coalition government with the equally anti-austerity independent Greeks, and thus it's just a matter of time before Greece either defaults outright or forces a massive debt haircut, entailing a complete and elimination of Troika austerity demands. After all, in his inaugural address, Serpas literally claimed, quote, Greece is leaving austerity behind, bailouts have ended for Greece, and the Troika era is over for Greece. And trust me, what starts in Athens will decidedly not end in Athens, as not only will the Greek, and Catalonian for that matter, votes empower citizens of other pigs nations, as I predicted in my 2015 forecast audio blog, but global financial markets will rapidly discount worst-case financial outcomes, of which I have little doubt will emerge. Subsequently, when trading opened Sunday night, as I predicted one day earlier, Thursday morning's euro plunge to 1.111 was filled, bottoming at 1.110 before again surging to 1.128, where it again topped out before closing around Friday's closing level of 1.124. Greek stocks and bonds plunged as well, but wouldn't you know it, the leading PPT organizations were in full perception-altering mode, with German stocks, for example, surging to an all-time high on expectations of not only fixed income, but Japanese-style equity QE in the coming months and years. As on Friday, the US PPT couldn't be more blatant. To wit, Friday's equity losses, amidst a calamitous commodity and currency plunge, were stopped, as usual, at the PPT ultimate limit down of minus 1.0%. And wouldn't you know it, last night's Dow futures opened down exactly 1.0% from where the PPT immediately started walking it back up. WTI crude plunged at the open from Friday's horrifying close of $45.29 per barrel to $44.80 per barrel. And wouldn't you know it, on perhaps the most PM bullish day imaginable, the cartel not only enforced its 83rd Sunday night sentiment capping of the past 84 weekends, but smashed PMs brutally in the 368th 2:15 a.m. raid of the past 422 trading days. By the way, to give you a quick refresher course on Greece, as initially outlined in my April 2013 article, Greek Tragedy, the first Greek bailout occurred in May 2010, 1 month after its credit rating was reduced to junk status. However, the crisis rapidly escalated, and by mid-2012, the Greek 10-year yield had spiked to nearly 50%. In fact, in my unprecedented article in August 2011, I specifically wrote that, quote, the Eurozone is on the verge of collapse, and frankly, I'd be shocked if it survives another 12 months. Well, lo and behold, nearly 12 months to the date, on July 26, 2012, the pigs crisis had so badly escalated that not only did Mario Draghi promise to, quote, do whatever it takes to save the euro, and believe me, it will be enough, but the Spanish banking system had to be given a $100 billion bailout. Irrespective of the financial calm this promise generated, the Greek economy continued to collapse while social unrest and political opposition grew dramatically. Consequently, in July 2013, I wrote that Greece is my top pick for most likely to catalyze the big one. And thus, following yesterday's historic, dramatic election results, we sit today at the precipice with only history's largest market manipulation schemes standing between all-out panic and said big one. What do you think? Can Wall Street permanently hold off economic Mother Nature? To that end, today's markets could not have demonstrated more blatant rigging across the board if William Shakespeare himself scripted it. To start, the Dow Jones Propaganda Average had its losses steadily erased by the PPT throughout the night in typical zero volatility fashion, and subsequently throughout the entire New York Stock Exchange trading day by a prototypical dead ringer algorithm replete with Hail Mary in the day's final moments to allow it to close 6 points higher. Treasury yields, like stocks, started the night at their lows, and indeed, when I awoke at 5 a.m. Eastern Standard Time, yes, that's 3 a.m. Mountain Standard Time where I live, was at a new low of 1.75%. However, with Wednesday's FOMC meeting just 2 days away, and the Fed in all-out panic mode, per an article I wrote 2 weeks back, they again executed a, quote, new Hail Mary trade to push rates back higher and thus prevent what I call the most damning proof yet of QE failure, i.e. plunging rates, as is occurring worldwide, amidst the so-called recovery they maniacally lie about. Throughout the day, rates fell to 1.80 several times, but each time the Fed was covertly waiting to push it back up, and yet it still closed at a paltry 1.81%, just as it did on Friday. And as for oil, LOL, the Fed and friends are trying every trick in their book to push it back up before Wednesday's FOMC meeting, just as they did before December's statement when, after they goosed oil from $46 a barrel to 51, Janet Yellen called the oil price plunge transitory, and thus enabling her to continue pretending all's well, with the Fed still ready to raise rates, albeit in a patient manner following a considerable time. This time around, said desperation couldn't be more transparent, starting with the wing and a prayer hope that Saudi King Abdullah's death would reverse the oil price plunge. Well, not only did it barely impact prices, but by Friday's end, particularly after, of all people, Treasury Secretary Lew espoused bearish comments, oil had closed at a 5-year low of $45.29 per barrel. Today, following an initial overnight decline to roughly $44.80, the day's latest, quote, bullish news was OPEC's General Secretary claiming oil could reach $200 a barrel if there's a lack of investment in the coming years. LOL, talk about talking your book and utilizing not a shred of actual analysis. Yes, $200 in oil could one day occur due to industry underinvestment, just as my grandmother could be a bus if she had wheels. In other words, while its production will surely be crimped, it could take years before today's historically high investment levels cause such a price impact. And by the way, if oil is set to rise sixfold due to lack of investment, what about precious metals, which due to 15 years of price suppression has seen capital expenditures plummet into the abyss, with roughly 3/4 of all exploration companies either having gone bankrupt or operating in living dead form without any operating capital? And by the way, no discoveries in these 15 years. Anyhow, despite yet another day of MSM hype about oil's subsequent surge, the day's high of $46.25 a barrel was well below Friday's Abdullah death high of $47.40. And wouldn't you know it, by day's end, WTI crude was at its low tick of the day at $45.03 a barrel compared to Friday's close of $45.29. Notwithstanding whatever desperation attacks the Fed's minions attempt in the next 2 days, it's looking painfully obvious that the current period of consolidation in the $45 to $50 range is nearing its end, potentially to far lower levels. Comically, base metals were again goosed higher, just as they were last Wednesday before plunging in the wake of the ECB's supposedly inflationary announcement. And as for precious metals, just how obvious can the cartel be? Historically, they have always worked overtime to quash PM prices in the wake of massively PM bullish developments, as they clearly did last week, relentlessly capping their rise following both the Swiss and ECB announcements. And last night, unquestionably, they were terrified that the Greek vote would spawn gold fever, particularly with gold already trading at or near its all-time high in so many global currencies. Thus, following the aforementioned overnight cap and attack schemes, they violently attacked at, drumroll please, the same 10 a.m. Eastern Standard Time key attack time number 1 they've utilized for the past 2 decades, i.e. the second the global physical markets close. In prototypical fashion, silver fell 20 cents in the space of 1 minute, and by day's end was the world's worst performing metal amidst the most silver bullish announcement imaginable. And oh yeah, news from the US Mint that Silver Eagle sales have already surpassed January 2014's level with a full week remaining. That said, watching the Huey start the day sharply negative yet rise in prototypical dead rigger fashion just like the Dow to close the day positive at its highs has me wondering if they aren't expecting a significant short-term gold and silver surge. Oh well, we'll just have to wait and see, as while such signals have a 100% certainty on the downside, the cartel works tooth and nail to prevent them on the upside. Oh, and by the way, I didn't even mention the day's economic news, starting with the catastrophic plunge in the Dallas Fed manufacturing survey, from 4.1 in December to negative 4.4 in January, compared to expectations of a flat reading of positive 4.0. Not to mention the all-out collapse of the production component from 15.8 to 0.7. Earnings-wise, you'd have to go back to the heart of the 2008 crisis to see a period where earnings estimates have collapsed this fast, with countless companies citing weakening economic conditions across the world, and in United Technologies' case, specifically citing the strong dollar I warned of in last week's most ominous quote of the year. Aside from such day-to-day trivialities, it's quite remarkable to consider that not one or two, but three historic central bank failures have come to light in a 10-day span. Not that the Swiss depegging, ECB QE, or Greek election revolt were either unexpected or even in question. However, the fact that they are occurring en masse should tell you all you need to know of just how close we are to history's largest Ponzi scheme imploding. In Switzerland's case, Thomas Jordan learned that economic Mother Nature cannot be usurped, and in the ECB's case, that open-ended money printing only makes things worse. To wit, not only has the Swiss franc's initial surge dramatically reversed, with today being its biggest one-day decline since the day the peg was initiated in 2011, but in the wake of the ECB's decision, commodity and crude price downward trends were accelerated, and incredibly, in one of the most damning proofs of QE's failure yet, an incredible 1.5 trillion euros of European government bonds are now trading with negative yields, compared to roughly zero 4 months ago. And thus, with 20% of the entire European bond market in negative yield territory, what could the ECB possibly expect to incrementally accomplish? Of course, today's title refers to the potential for one or possibly two additional central bank failures in the very short term, each of which with the potential to once and for all destroy the destroyers. For one, I cannot emphasize enough how desperate the Fed is to create an artificial environment of confidence, even moderately so it can avoid making dovish comments on Wednesday and continue to pretend it may one day raise rates. At this point, it's getting downright comical how anyone can actually believe that with rates at or near all-time lows, economic activity collapsing, oil prices imploding, the dollar surging, and massive geopolitical crises in Greece, the Ukraine, and countless other regions, that the Fed would even consider rate hikes. However, as I discussed in my TikTok audio blog 2 weeks ago, the inevitable Yellen reversal is coming, and frankly, if the Fed fails to hold PMs down, support stocks, bond yields, and commodity prices, and prevent the euro from collapsing further in the next 2 days, it may well come Wednesday afternoon when the FOMC issues its policy statement. And last but not least, I want you to recall what I first predicted in Friday morning's most ominous quote of the year, and expounded on with the Shadow of Crisis audio blog I taped on Saturday, regarding the boiling teapot that the Chinese yuan's peg with the dollar is becoming. Quote, when the Chinese are shortly forced to abandon their ruinous peg with the dollar, my guess is the yuan goes down, not up, for the same reason all of the currencies are falling, which of course will cause yuan price gold to surge, compounding already record demand, not to mention utterly annihilating what's left of corporate American earnings. And if you think speculators and sovereign banks lost a lot of money betting against the Swiss franc, just wait until you see what happens when the yuan peg is broken. Now, such a view could not differ more from the consensus that the yuan is undervalued, particularly when our moronic government continues to, ironically, accuse the Chinese of being currency manipulators for supposedly holding the yuan's value too low. However, I strongly believe that between now and the yuan's future resurgence, when the world finally realizes how much gold China owns, it could plunge precipitously as its historic equity construction, real estate, and shadow banking bubbles collapse, with 1.5 billion citizens relying on the government for salvation. Moreover, the non-convertible yuan is far less liquid than most currencies, and in a crisis environment in which liquidity is at a premium, my guess is it not only declines against the dollar if depegged, but in a big way. Remember, the reason the Chinese pegged the yuan in the first place was its goal of keeping it weak. But now that its fundamentals are actually weaker than the dollar, the peg is preventing it from weakening, and thus destroying Chinese competitiveness against countries with plunging currencies like Japan. Last week, I deemed the SNB and ECB actions as big bangs that will long reverberate, negatively so, across the planet. However, when the Chinese inevitably depeg the yuan, which frankly could occur any day if the dollar index continues to surge, such events will be deemed inconsequential in comparison, as this would be the biggest bang in the history of monetary policy. And thus, when last night, just one day after my prediction, the Chinese fixed the yuan peg at its lowest level since November 2008, it couldn't be more obvious how close a more dramatic devaluation might be. Ironically, this occurred whilst the yuan simultaneously traded at its highest level against the euro in 14 years, further demonstrating just how desperate the PBOC is likely to become in its quest to retake the lead in the mutually destructive, globally suicidal, final currency war. Alas, I think I'll call it a day and take my rest. awaiting who knows what cataclysms between now and Wednesday afternoon's potentially historic FOMC statement. Even if the aforementioned Yellen reversal is somehow staved off by unprecedented market manipulations, it's coming as sure as night follows day, as is the end of the yuan dollar peg, and both the efficacy and credibility of all central bank actions, likely in my view sometime this year. And thus, I'll conclude as always by urging you to protect yourself and do it now. And for those that decide to take action,